Welcome everyone to today's SCORE and Spectrum webinar on managing funds and funding with Ron Dooley and Carolyn Katz. For today's webinar, you are in listen-only mode, meaning that your audio is on mute. We recommend that you maximize your Zoom window for an optimal experience. We will have opportunities for Q&A, so you can submit your questions at any time via the Q&A feature at the bottom of your Zoom window. We will hold on to your questions and then we will address them when we pause for Q&A. So again, submit them at any time. We are going to send you after the webinar the slides as well as a webinar recording. So this webinar is being recorded so we can provide you a copy afterwards. Let me turn things over to Tim Cantato to tell you a little bit about SCORE.
Thank you, Kendra. Hello and welcome everyone again. As Kendra had mentioned, my name is Tim Cantato, and while I'm not your presenter today, I have been a SCORE mentor for the last 5.5 years. So what I wanted to do was take a moment to describe a little bit about the SCORE Association. SCORE is a nonprofit organization really dedicated to fostering, vibrant small business development and communities through mentoring and education. Sometimes known as Advisors to America's Small Business and celebrating about 55 years in existence. And we have over 10,000 volumes, over 325 chapters across the United States who dedicate their time for free mentoring services to our clients. SCORE offers mentoring, workshops, and webinars similar to the one that you were participating in today, advisory board services for more established small companies, business owner roundtables for networking opportunities for entrepreneurs, and information services like the website and forms that you can then download from them. Our SCORE mentors are experienced in a lot of different areas like marketing, finance, sales, etc. And they're available to help businesses in all stages of development, whether they be in pre-startup, startup, or ongoing modes. The way SCORE has trained their mentors is they encourage ongoing relationship with their clients. So that means that you will get more than a one-time meeting with your SCORE mentor. So you might be asking yourself, how do I take advantage of this free mentoring service from SCORE? Oh, by the way, I also just wanted to say that with Spectrum, we have produced 4 or 3 previous webinars, and we have 2 more webinars coming up on 6/18 and 6/28. Carolyn Katz, who is one of your presenters today, and I will be presenting one at the end of the month. And so I hope that you guys can visit and register with us then. All right. So how do you go ahead and take advantage of the services so you can request a SCORE mentor? The first way to do it really is to go to www.score.org and click Find a Mentor. You go ahead and enter your zip code and fill out the mentor request form. Afterwards, you will have a mentor get in touch with me. It really is as easy as 1, 2, 3, just like that. Right now, what I'd like to do is to introduce Jennifer Ingram, who is a Vice President of Marketing for Small and Medium Business.
Thank you, Tim. As Tim said, my name is Jennifer Ingram. I'm the Vice President of Marketing with Spectrum Business. And as you may know, we provide internet, voice, TV, and mobile solutions to small businesses across 41 states. I would just like to say that we at Spectrum Business are really pleased to be sponsoring today's workshop, and we're really pleased to be partnering with SCORE. Spectrum Business and SCORE, essentially, at the end of the day, we share the same goal. We want to help small businesses thrive. And we know that small businesses are the backbone of the economy. And in fact, in many ways, small businesses are the glue that holds the community together. I know in my community, the small businesses really define the landscape, and they're my favorite places to be. So that's why Spectrum Business is sponsoring this series that's brought to you by SCORE. It's really important that we provide the support that businesses need to start and grow their business, and that's what this series is really all about. So I just wanted to thank you for attending today's session, and on behalf of the entire team that I represent here at Spectrum Business, I really hope that you find the session helpful. Thank you.
Thanks so much, Jennifer. So with that, we're going to ask that you buckle in and enjoy the webinar. Our first presentation is with Ron Dooley on managing funds. So I'm going to turn things over to Ron to introduce himself.
Thank you, Kendra. And welcome, everyone. I'm looking forward to this presentation. This is an interesting time that we've been going through. As you can see, I had a COVID beard, which I no longer have. That's my way of looking now towards the future as we see the light at the end of the tunnel, and some optimism and some interesting times ahead as we start to rebuild our economy and move forward. So with that, let's dig into this. So which way do I go from here? There's a couple of things that are very important to consider, and a roadmap is one of them. We're talking about funding, and I'm going to specifically be funding your business, and I'm going to be talking more specifically about liquidity, cash flow forecasting, in managing your finances in that regard. Okay, so our roadmap is basically understanding your business, and don't forget understanding your operating environment and the importance of cash flow to your business, and then forecasting the receipts and disbursements or your cash flow, how to do it, and what are things like working capital and liquidity, and then some key takeaways as well. So understanding your business. There's three questions that I think are very important for any business person, whether owner or operator or however you want to describe yourself, should always ask and continue to ask on a regular basis. And that is, where is your business now? And where do you want to take your business? And what resources do you need? And what do you need to do to get there? So a great way of doing this is actually gaining perspective with a SWOT analysis. And this is a brainstorming exercise that really helps you to synthesize your thoughts and put it on one page. And it gives you a lot of perspective, because we have a tendency to get caught up in our daily lives and lose perspective, and perspectives change. And this is just a way of reorienting yourself. And it has four key components: the strengths, or what do you do well; weaknesses, what could you do better; and opportunities, what trends or events in the marketplace can you take advantage of; and then threats. And these are the uncontrollable external factors in your environment. And really, there's not much you can do about them except figure out contingency plans. And did you have one? And the pandemic has been a perfect example of that. Nobody knew where this was coming from, or that this was coming, and it hit really hard. And it was very hard to prepare for or develop any kind of contingency plans. But it's amazing to see how some businesses have reacted, and how dynamic small business owners in particular are, and have addressed these challenges. So here's a template or just a depiction of how a SWOT analysis might look. Some people put them in just 4 different boxes on a square piece of paper. This one I like because it makes a little more it's a little more visually stimulating. Okay. Then what you want to do after you've completed that SWOT analysis is take a critical review of your business. And we bucket these into 4 different categories. Your marketplace. Are there clear opportunities? And this is really kind of assessing sort of what's going on at this moment in time for your business. Are there clear opportunities for you to take advantage of? And how do we make money? Sometimes it's a very difficult thing. Sometimes it's an easier thing. Financial flexibility. We've got plenty of cash. We don't have any problems meeting our bills or obligations as they come due. Or are we stretching? Are we having to really juggle and put off paying some bills that we have so that we can meet others that are more pressing? And operations and logistics. Is the business running smoothly, or are you just running from one fire to the next fire, and all kinds of unexpected surprises are coming up? And then generally in management, are you engaged with your business? Are you loving life? Do you get up in the morning and really like to be there? Or at the end of the day, it's just like, man, when can I go home? And you should risk assess each of these areas so you can act quickly to identify any risks and resolve or navigate through and around roadblocks. These are really important things. Doing this critical assessment will help you identify problems that you need to address and not hide from them, and you can prepare for them. And don't forget your operating environment. We've really been through a lot this past year. It's been a tough time. This country is made up with about 50% are small businesses, and they've got hit really hard. Their incomes have dropped by more than 20%. And in particular, in places like leisure and hospitality, it's been more like 50%. So it's really been a very difficult time. And understand that environment you're working in. And the importance of cash flow. This is one of the main topics or the main focus of our presentation today. It's always important to understand cash flow. Anyone can and everyone should monitor their cash flow. Understanding is key to your business health and growth. And it's not the same as profits. It's used to fuel your business. There are many stories of highly profitable companies running out of cash and ended up in bankruptcy and other things, just because they didn't understand that profits and cash are not the same thing, and you have to turn profits into cash. And more important than and complements in external funding. So this is really, again, it's the lifeblood of your business. And it's important in good times and crucial in a crisis. Okay, so we're going to have a poll now. Kendra's going to pop it up on your screens, and please select which of these things are would fall into. Would you have feel is suit describes you the best? Are you ever surprised by the amount of cash in your bank account?
We'll give it a little bit as we have lots of responses coming in. So yes, make the selection that best applies to you.
And this goes both ways too, whether you're surprised by having too much or too little. I've had both of those experiences.
Yes. So I'm going to go ahead and close out that poll and share the results.
Yeah. As you can see, always, it looks like most people are pretty good in that regard, sometimes at 39%, and rarely at 34%, and never at 22. So actually, it sounds like people have a pretty decent handle on their cash positions. Okay, now let's start looking at forecasting cash flow or receipts and disbursements. Cash is the most liquid of all assets, and a business must maintain adequate control over it to survive and prosper. And how you gain control over it is by forecasting your receipts and disbursements and using proper assumptions for the timing and the amount of when those cash flows come in and go out. Okay. And here's a cash flow life cycle. And this is a good way of just seeing how it flows through your business. If you've got sales, they can be cash or on credit, depending upon the nature of your business. And on credit, they become accounts receivable. You can't pay your bills with accounts receivable. So you need to convert those into cash collections. And once you have collected on those receivables, turn them into cash, you can pay your operating expenses, purchase inventory, pay your own invoices to suppliers, and make capital investments in your business. And then it flows around again in another cycle. So it's an ongoing cycle that your business is always caught up in. Okay. And what is cash flow forecasting? It's a tool to help companies understand and manage their short-term cash liquidity needs. This is very tactical, short-term. It's not a strategic planning event. And when do you need it? Really always. And it becomes really, really important in times of distress and a crisis. And you'd be surprised at how quickly cash can be depleted, especially if you don't have a good handle on what your cash position is or how your business generates cash. And the purpose of this, of cash flow forecasting, is to illuminate the road ahead to help you identify potential risks and make informed decisions so that you're able to meet your obligations as they come due and not be surprised. Cash flow is a balancing act. You almost will never be correct. You'll always be a little bit over or a little bit under, but it's kind of like horseshoes and hand grenade. It's close counts. And don't get discouraged if you have forecasts that aren't matching your expectations. Just learn from that and keep moving forward. We suggest to use it as a timing tool over a 13-week period. That is sort of standard practice for finance professionals that help with the cash flow forecasting. And the reason for that is that represents 1/4 of a year. It's short enough that it's relevant and you can be relatively accurate with it and confident in your forecast. And it's long enough to give you time to be able to respond to any issues or surprises or things that you didn't know might be coming up on the horizon. Okay? And it really focuses on when do you collect your revenues, pay your employees and expenses, and make investments, and in what priority. Don't ever forget priority. Assumptions are informed by your past experiences and the current environment and your future investment plans. How has the environment changed? Don't reflect a rosy scenario. You really have to reflect the current state. And this is probably the most common error that people make when cash flow forecasting is they tend to be too optimistic about when they're going to collect on receivables, how they're going to pay their payables, and what their cash position is. We recommend doing this as a weekly exercise, since we're doing it in weekly periods over a 13-week period, and to do it and make it part of your everyday business operations. And then each week, assess, learn, and adopt from the previous week's variances. Don't get frustrated if you don't get it right. Just keep working towards. Over time, you'll learn a lot about your business as you go through this process. Okay. Assumptions. The timing and amounts really map how cash moves through a company to reflect a clear picture of your liquidity. The input data comes from point of sales, invoices, bank statements, places like that. You'll find you have a lot of data to draw from. And there's two things to think about when disbursements are greater than receipts and receipts are greater than disbursements. What you need to understand is whether these are temporary or permanent, and if they're going to reverse themselves so that you're going to have a positive cash flow or you're going to have a weekly cash burn. And if you discover that it's a cash burn and it's not going away, how long is your cash runway? How long before you run out of cash? And again, it helps inform you to make decisions to improve the situation. And you really need to determine when your receipts are greater than disbursements, is this due to operations or the rate of collections improving relative by rate as you're collecting those receivables faster than you previously have, and as a result, you're bringing in cash faster than expected. And that is always relative to the expenses that you paid. So you want to understand how profitable and how much cash your operation generates. Okay, so how it's done. Past results inform future performance. So we look at just establishing the baseline, and one option for doing that that's relatively easy is to just take a look at the average previous 4 weeks. Sales, expenses, where you pay your money, things like that. It's going to vary depending upon the type of business you are. If you have a seasonality to your business or a cyclicality, because if you're seasonal, you might do more business like retail operations as around the holiday season, and then you're collecting more in the winter, and then you've got dry periods in the spring and summer. And then a lot of expense going out in the fall as you're ramping up again for your to build inventory in advance of the next holiday season. So keep those all in mind as you do this. But the 4 weeks is the previous 4 weeks is often a good place to start in building your baseline. And quantify what are your reoccurring versus your one-time sales and expenses. And this is because one-time is sort of a surprise. It's not going to reoccur. And that's one where you need a little extra cash aside from. And the reoccurring is really the ongoing basis of your business. And distinguish between fixed and variable costs. The fixed ones are the ones that are not going away, even if your revenues are lower or higher. They're the same. They don't change. And the variable costs move with movements in your revenues. So if you have a bit of a tough period, and like we have had with the pandemic, and revenues fall, your fixed costs don't go away. So you can suddenly turn into a situation where you're not generating cash. And in fact, you're burning it very quickly. But if you're growing your revenues, the incremental revenues will drop to the bottom line very quickly once you've covered all of your fixed costs. And apply the current environment to your forecast. How are your customers doing? How am I doing? And what are planned strategic investments? So the real point about understanding your current environment is also understanding that, especially as a small business, we're all connected together. Whether it's to your customers or suppliers, these actions that you take reverberate through the system. Actions that they take reverberate through the system and affect you as well. And you've got to understand how that happens and how that affects your business. Okay. And now we can start. Let's fill in a 13-week receipts and disbursements template. And this is an example of one that we use. So first of all, here's the baseline. And you'll notice that I have the 4 weeks, prior 4 weeks, week number -4, -3, 2, 1, and then a weekly average. And this is a fairly basic, clear depiction of how this practice works. And when you're finished, the beginning and ending cash should match your bank cash balances. Okay. Again, though, it is an art more than a science. So you're going to have periods of time where you just don't hit it right on. Okay. And then apply the current environment. Identify any cash pressure points. That is, if you've got a big expense that's coming up and you have to make sure that you raise cash in advance of that expense so that you can meet it as it comes due. Unavoidable and deferrable disbursements. Those are situations where you can, if you're tight in a particular period, you can avoid those or push them off to preserve some of your cash position and then pay them at a later date. In all contractual obligations, these are the ones that you are obligated to make. You in a difficult time, you may have to go have a discussion with the other party in the contract to see if you can seek relief or other things like that. But those are contractually obligated, whether it's a lease, things like that, or if you've got some other particular agreement on inventory purchases and things like that. Also identify all sources of potential cash that you could raise if you need. These should include non-operating and possible asset sales. So I often use an example of a coffee shop. Maybe you've got an extra old espresso machine that's perfectly fine, but you replaced it with the latest and greatest to get some better efficiencies in your business. That just because you're not using it doesn't mean that somebody else wouldn't have value in it. See if you can sell it. See if you've got extra inventory that is just not going to be usable, or it's starting to get old. You'd be surprised at who might have value or see value in that inventory and be able to, you can turn that into additional cash. I once had a company that I was working with that made gas analyzers, and their components went into things like analyzing the chemicals and emissions and exhausts, as well as in surgeries during a patient's as they breathe. It would analyze what different components are in their breath. And they had excess inventory as they had switched to a newer product, and they didn't know what to do with it. And surprisingly, they put it on eBay and couldn't believe that they found all kinds of interested buyers willing to pay full price for those products, and they were able to turn those into cash. So there's a myriad of different ways that you can do this, and think creatively. You just never know. And quantify, again, as I mentioned, reoccurring versus one-time sales. So this is both on the sales and also the cost side. You don't want to get optimistic or think that because you had a great sale that it's going to repeat on an ongoing basis and your business is now bigger than it previously was. It could only be one time, and you have to manage for that. And the magnitude of your fixed versus variable costs too. And this is really your operating leverage. The greater those fixed costs, the higher your operating leverage. And that just means once you cover those fixed costs, every incremental sale after that drops straight to the bottom line. But if you're not covering your fixed costs, you're going to bleed cash, and it can be very painful. And avoid making lump sum payments in advance of the actual expense. This is really prepaying expenses before you receive the benefit. There's no need to be a little absurd. Prepay your rent for 5 years, as an example. It would be a huge cash outlay that doesn't match up with your cash inflows. So, I mean, it might scare your spot for 5 years, but maybe you're going to decide after 2 years that you want to do a different business, or you want to move locations or other things, and you get stranded. List and prioritize. This is very important as well. And a lot of people don't always do this, at least not in a formal manner. Accounts receivable collections. Consider offering inducements to speed payments, example, discounts. Accounts payable. Which vendors are critical to your operations and which are not. You really want to know that, because in a tough time, you want to make sure you're paying those critical suppliers so that you can keep your business going forward. In planned strategic investments, really prioritize those. Decide which ones are imperative to the success of your businesses and which ones can be put off to another time. Okay. And consider alternate suppliers. Some may offer better terms, and it's always good to have more than one, even if you love your particular supplier. You need to have more than one as a backup in case something happens to that supplier. You need alternatives, and it always just helps inform you of what the prices and terms are out in the marketplace. And negotiating payment relief of contractual obligations. If you have a real issue, a lot of this presentation, because we're discussing in the backdrop of the pandemic, because these are issues that people have been dealing with in living very intimately over the last 18 months. So things like contractual obligations. Just because you entered into a contractual obligation doesn't mean that you can't renegotiate it, and it doesn't mean that the other party, like a landlord or even a bank, a lender, isn't willing to work with you to help find ways to relieve the obligations of that, so that you can get into a better place in the future. They want to preserve a good relationship, but every one of those parties is different. So some are easier than others. Review and analyze what-if scenarios. Can I invest in a new strategy or not? Do I have the wherewithal? Inventory management, optimize it, don't minimize it. I had one company once, a very well-known clothing manufacturer that I was working with, and they had decided they wanted to really shrink the inventory that they held for their on hand, and it could release about $100 million in liquidity for them. So they did that. The problem was they lost control of their operations because they did it at the same time as they were moving to a different country. And suddenly some of their products were being manufactured incorrectly and were unsaleable. And when that happened, they essentially crashed. They didn't have anything to sell. They weren't generating sales and cash flow, and they faced a liquidity crisis. They eventually got control of that, but just make sure you optimize your inventory. You want to make sure that you don't give up good, profitable sales. And adopt lessons learned from the prior week in your forecasting into the next week's forecast. This really is a learning exercise, and if you stick with it, you'll get better and better and better, and you'll know your business better than you ever imagined. Okay, here's the actual forecasting. Okay. And it's a template. We have examples of this. If you need help with these things, also, I'll point out that SCORE has lots of great mentors and people that can advise and help you do these things and help you complete templates like this and go through this process and adopt it. And it's all free, so you can't beat that. Okay, and then review your weekly variances. Okay, what happened? What was my forecast and what was the actual week like? And then put some details beside that. Were you able to collect a little bit faster than expected? Did you have an unexpected need to purchase a new piece of equipment that had failed? Was the weather warmer than expected, so you had a higher air conditioning bill, or colder than expected, meaning that you had to spend more on heating? So identify the reasons for these variances and be specific, and timing of them is important too, because oftentimes a variance is really only related to timing. You might find that a customer hasn't paid you when expected, but it's just because they're on the other side waiting to get some money in from another client, and that's due in. And it could be just a matter of they're gonna pay you in the next week as opposed to the week expected. but also understand if these variances are a temporary or permanent phenomenon, if there's any change in the credit risk of your customers, and if you have performance issues with either clients or vendors. Okay, so we're going to do another poll here. Are you familiar with what working capital is? This is a very, very important part of cash flow forecasting. It can be a little bit complicated, and people have a little trouble understanding exactly what it is.
This will give us a read on where everybody stands in terms of their familiarity at this point, and you will become more familiar with it in just a moment. So we've got a lot of responses coming in. So I'm going to go ahead and give it just a few more seconds. Okay, I'm going to go ahead and close out that poll and share the results.
Okay, so we've got 13% that don't know what working capital is, 23 that know a little bit about it. So that's pretty significant, about a third of the group, and then 40% somewhat. So we've actually got a lot to learn about working capital here, and then 25% are very familiar with it. If you understand working capital, it will help you enormously. This is, I explained a scenario in the past where there are highly successful companies that have run out of cash and ended up in bankruptcy, even though they've been profitable. And this is where working capital comes in. Those profits got hung up on the balance sheet and they weren't converted into cash. And that process of getting hung up on the balance sheet is in the working capital. So you always want to manage that working capital. It is a true investment as well in your business. You need it to operate, okay? And what working capital is, first of all, it's a crucial investment where cash can easily become trapped, especially during a crisis. And it equals cash plus accounts receivable plus inventory less accounts payable. In the simpler term, it's your current assets minus your current liabilities. Those assets that can be turned to cash within a year, and those liabilities that are coming due within a year. Okay. And cash on hand, well, we all know what that is. That's the most liquid thing as well around. And accounts receivable, it's what a customer owes you for a sale on credit. And if you accelerate the rate of collections of those accounts receivable, you will increase your cash position. In inventory, parts you purchase to assemble a product for sale or use to provide a service. If you shrink inventory, this will increase your cash. Now remember, we want to optimize inventory, not minimize it, because it's a really crucial part of the business. So you really have to watch your inventory. I often use an example of a coffee shop because you have a lot of different components that work in that. In inventory in a coffee shop, you're looking at your coffee beans, in your coffee cups and other things like that. If you minimize it too much or shrink that inventory too much, you may not be able to produce the coffee, or if you can produce the coffee, you may not have the cups to serve it into your customers, so you're going to lose sales. So you really want to manage that carefully. Accounts payable, what you owe a vendor for a purchase on credit. Okay, if you increase, that is delay or stretch the payments, you increase your cash. So that is if you're, as an example, you make a purchase on credit and it's due in 15 days. And if it's a critical vendor, you want to really work to make sure that you can meet those payments as they come due, because that critical vendor could shut down your business. And I've seen that a lot that's very crucial. We're starting to see it a lot these days in our supply chains around the world, thanks to the pandemic. I worked with an auto company supplier a number of years ago, and they made some key components for airbags. And they were getting very frustrated with some of their customers, the big car manufacturers, because they weren't being paid as they needed, and they were facing some tight liquidity situations. So they took the audacious step of refusing to ship components, and they actually shut down the assembly lines of some of the big auto manufacturers. And that is a really dangerous thing. It's bad for your relationships with your customers. And in fact, the auto companies went into court and mandated that this company supply them with products so they could keep these lines running. And these things reverberate through the entire economy, because if that car production shuts down, it's not just the people that supply the components for airbags, but it's also the people that sell tires that go into that car, and sell different metal and aluminum parts. There's a huge number of vendors and suppliers that go into the manufacturing of a car, and it stretches all through the entire country. So that's a good example for understanding how we're all connected. Okay. In wringing working capital, we like to use this example. If you think of a towel that's filled with water and you want to get all of that water out, which is your cash, and you squeeze it as tight as you can. And again, it's a balancing act. Accounts receivable, trying to collect them in a timely manner, making sure that you understand that your customers are willing to pay and when they're paying, and inventory, finding a nice optimum amount, and your accounts payable, making sure that you pay properly but not too fast. And these are your levers. On the receipt side, cash sales. If you have cash sale, it goes straight into cash versus a receivable sale. Pursue your accounts receivable collections and shrink your inventory, especially if you can. Don't ever buy too much inventory if you can help it. And the disbursement levers, delay your accounts payable payments, push them back if you're in need of cash, push them an extra week or two, and that will help keep a little bit more liquidity in your system. And prioritize the expenses that you have. You've got to pay your people, as an example. If you're not paying your workers on time, they have rent to pay. They have other obligations as well too, and they need to be able to depend upon that paycheck. So that is an example of a priority expense. And avoid those lump sum prepayments. And it is, we talked about before, paying for something in advance of being able to get the service. The larger that prepayment, the less, the more it impacts your cash, and you don't get the benefit of it for a long period of time. Okay. Working capital, I don't want to, so there's a lot of different complicated parts of working capital that we can discuss, whether it's days payable outstanding, days sales outstanding, inventory turnover, and cash conversion cycles. But this is an important one to think about, and it's called an aging schedule. And there's two parts of it. There's accounts receivable aging, accounts payable aging. And so you've got customers and you've got vendors. On the receivable side, I use ABC Corp, XYZ LLC, and Jack and Jill. And they are clients that you've sold. So they sold a product or service to on credit, and they owe you money. Are they paying you on time? And so you want to age that. As an example, if you start to see that a customer is moving away from its traditional patterns of paying you within, say, 30 days or 60 days, or they're moving from 60 to 90, there's a migration. The more they start to extend out how quickly they're paying you, the more you're providing them essentially free financing. And you have to find ways to, you have to ask questions about that. Make sure that that you're collecting in a reasonable time frame. If a client starts to stretch you or push you out, say to beyond 90 days, if that's considered a long period of time in your business, then you should start asking questions. Maybe that customer is actually having some financial difficulty, and so they're trying to manage their cash carefully, and so they're not paying their suppliers in a expeditious manner. So, and that's where you can start to identify any credit risks where you might have a receivable that becomes delinquent or that you're not able to collect upon. And you should identify those, prepare for them, because there's nothing worse than getting a surprise that you're not going to get paid on a large receivable and that you have to write it off. Now, the same goes for accounts payable aging. This is the flip side, though. These are your vendors. So they're now the ones that are looking at you as the customer. How do you manage that? And it's a game, and it's an art, it's not a science, and you have to manage your relationships. You need to understand who are your most critical vendors to your business, which ones, if you need to raise cash, you can push out how quickly you pay them a little bit to raise a little more cash, or if you're flush, paying them on time and other things. But generally the view is never pay any sooner than you have to. You want to preserve that cash for yourself and your business. Okay. So let's talk about key takeaways here. Build a weekly cash flow forecasting into your standard operating procedures. This is really making it part of how you run your business. And this is a tricky thing. It really, it becomes, it's like developing new habits, and you want it to be a good habit. And you want to get into this habit and doing it every week in understanding what's changing in your business on that time frame. Manage funds in good times and bad. It really is important. In good times, you never want to get too complacent, because difficult times can come along at any moment unexpectedly. And the better you manage and more carefully you manage your cash in the good times, the better prepared you will be in the more difficult. And know how much cash is actually needed to run your business. Okay? Understand how much is tied up in your working capital, how much can be brought into the bank account as cash. And know your liquidity run rate. How long will your cash last? This is really key in terms of if you're going from a good time period to a bad period. You want to know how long you can ride out a storm. This pandemic has been much longer than anybody expected. I can never forget in the early days hearing, it'll be gone by spring, and once the weather changes, it'll magically disappear. And it didn't. It was much worse than anybody had anticipated. So you need to be prepared for these things, have some contingency plans. And evaluate options often to make informed decisions. Determine, can I invest in my business to grow it? And what might that investment be? Is it a long-term capital investment, or is it an investment in adding some additional staff because the demand for your products and services is much higher than needed? Should I maintain the status quo? It's right now is good. I'm not quite sure how things are looking for the future. I'm not as optimistic as I'd like to be. So let's just keep it steady as she goes. Make sure that we really tighten up the ship and have it operating in a very good manner. And then, is it best to hibernate to build cash and wait for better times? And this is if you can start to see difficult times on the horizon. Build your cash and create kind of a fortress around your business so that it's durable, it can ride through a storm, and then it's in a very good position to take advantage of when times are good. As we come out of this pandemic, a lot of companies have failed and had a lot of trouble. And I say to everybody, don't hesitate to ask for help if you're having a difficult time. People at SCORE are great for this kind of thing. We help people in all types of environments, whether it's growing businesses or getting through difficult periods with little cash. You never quite know what you don't know until you start asking questions, even if they seem like they're embarrassing questions or you're afraid to. Don't be bashful. Shyness never gets you anything. So we can do Q&A now, I guess. Kendra, are we going to do that or go right on to Carolyn's section?
I do have some questions for you.
Okay.
Could you please explain the profit margin concept?
Profit margin concept. I'm not exactly sure what you mean by that, but profit margin, there's a couple different ways you can look at it. One is there can be when you purchase an input that you're going to turn around and use in the assembly of a product for sale. That would be the difference of the cost of those inputs and what you can sell them for. And that could be your gross profit. And then there's operating expenses, which would be things like utilities and other items, employees, that come out of those operating expenses, and then you get a net profit margin in the bottom. Is that?
Thanks. How do you know when it's time to use profits for something else than the business, so for personal income?
So I'm cautious on the use of profits, because profits are an accounting term, and we're really focusing on cash. So profits over the long-term, profits and cash generation should generally match, but you'll find that they don't over a short period of time, and these will fluctuate. The differences will fluctuate and show up in your investment and working capital and other things. So be mindful and understand the differences between profits and cash. Now, if you're a highly profitable company and you're very good at turning those profits into cash, you're going to have lots of opportunity to use that cash for investments or to pay yourself or other things. But just make sure that you've got a good handle on the difference between the two.
Thanks. What is the average number of months we should build cash to weather tough economic environments?
That is a really excellent question, and I wish I could properly answer it. It depends on your business. It depends on what your needs are in terms of, again, going back to fixed and variable costs. If you've got a lot of a very high level of fixed costs, you're going to need a lot more financial flexibility, a lot bigger cushion of cash to weather that storm. And this comes into that idea of forecasting your cash burn and your liquidity runway, how much time you have there. So nobody could have envisioned how bad the pandemic was and how hard it would, especially if you're in leisure and hospitality, like a restaurant operator, and you've got to shut down, and suddenly your revenues drop to basically zero, but your costs are still there. You want to keep your location. You don't want to let go of your employees. Other things like that. And then how long is it going to last? In this case, 18 months. It would be very hard to advise a business to have 18 months worth of cash on hand if their revenues turn to zero. This is a low probability scenario. So you really have to determine what is your comfort level. The more resources you have or ability to borrow or access, say capital markets or friends and family for loans during these difficult times, the less you'll need on hand. Or if banks are very like your business and are very supportive. Now, you also have to be careful that sentiment doesn't change when things go bad. And during good times, everybody falls all over themselves to provide you liquidity and loans and money. But then when it's bad, they get very scared and they don't want to provide anything. And that's the time when you need it most. So it is very personal to your business. And this is what you want to evaluate as you're doing this cash flow forecasting and understanding how much you need to invest in working capital.
Thanks. Should I avoid lump sum payments for something that's used over a year, even if it means getting charged interest?
It depends. Generally, I say avoid those lump sum payments in advance, especially if it's over a long period of time. A year is a pretty long period of time. If it can be paid on shorter periods, like as an example, when your rent on your storefront, you pay it generally monthly. You don't necessarily want to pay it for a whole year. Now, there's a couple of things to think about. If you pay it for a year, maybe your landlord will give you a nice discount. So it's a source of financing in a way, and it's cheaper than borrowing or other things. However, it doesn't match with your cash inflows. So you have to have the resources to be able to do that. And then the other side of it is what might change in that year. If it's a storefront, maybe you decide that your business is very successful and you outgrow the size of that store and you need to move in 6 months, but you're stuck. So there's different, again, these are all different important variables that you have to weigh in considering that. But generally try and match your cash inflows with your outflows as much as possible.
Thanks. Where do you look for cash on balance sheet if your example of they're sitting idle and unnoticeable?
Well, this is working capital exactly. And in fact, what you find is if a business is shrinking, if their sales are going down, their working capital is shrinking too. You can work on developing a metric of how big or how much working capital you need as a percentage of sales. That's one way to look at it. And if you manage that, what is an optimal amount of working capital? And if you can manage that down, then you'll find more cash. But on the balance sheet, it can be anything from excess inventory that you're not going to use, or if you hang on to it, it's going to go obsolete or bad. Think of our coffee store. If the coffee beans, if you buy 2 years worth of coffee beans, they'll probably go bad within 6 months, and then you've got a loss on that inventory investment. So look to see, well, how much of it am I selling? Do I have an excess amount that I could sell to the coffee shop in the next neighborhood or something like that? And that's a way to generate cash. Also, any machinery, equipment, other things that that you have lying around that can be functional or used by somebody else. If you can sell it, that's a way of generating cash.
Thanks. If my business is known or supposed to have no revenues for the first 3 years, how should I plan my cash flow?
Well, you have to, the plan is, since you're all focused on the expense side, this is the a 3-year period is a pretty long period of time to not generate revenues. So this is the investment. This is the capital required to start your business, invest in it, build it up, create it so that it can generate revenues. And it's really coming up with a detailed line by line focus on all of those expenses and forecast those out. And you can still use the same cash flow forecasting tool that we're using here, but now you wouldn't do it on a weekly basis, which is a short term, but you're talking more strategic planning now. And you're at 3 years out, you want to get a sense on a month by month basis how much you're going to need to invest and when as part of starting the business up. You don't want to go and invest a whole bunch of money in something like buying an equipment that you can't use for another 2 years down the road, as an example. And unless maybe there's a 3-year lead time or whatever on the purchase of that equipment, but you want to have it matched as closely as possible to the timing when it's going to generate revenues to cover those costs.
Thanks. Could I count all the, say, angle funded capital as cash flow?
Sorry, could you repeat that question?
The angel funded, could I count angel funded capital as the cash flow? Yes.
It's an outside source of cash that's coming in. It's an investment. So that money is cash. I don't know, sometimes the angel investor may have conditions under which you can spend that cash. But that is part of the capital to start the business and invest the business and get it moving. So that is actual cash. It's brought in, there's an obligation that you're giving, whether it is in the form of an equity share of your company or some kind of a loan obligation or note or preferred equity or something else. But there is an exchange in there. But yes, you're getting cash in exchange for that obligation.
Thanks so much, Ron. Those are all the questions we have at this time. Let's go ahead. Would you go to the next slide, Ron?
Sure.
Thank you. So we're now going to move to the second part of our presentation, Funds and Funding, Manage and Grow, with Carolyn Katz. So I'm going to turn things over to Carolyn to introduce herself.
Okay, thanks so much, Kendra, and thank you, Ron, for that wonderful presentation. My name's Carolyn Katz. I have a background. I started as a business analyst, looking at all the kinds of things that Ron's described in terms of the cash flows and the spending of companies to try to understand what makes a strong and sustainable company. I used that then as a lender. I was a VC, a venture capital investor, and probably most important for this conversation, I also started and ran my own business. So all the things that Ron's talked about and all the things I'm going to talk about are things I actually did in my own business. I know they can be done, and I know they're really valuable to helping manage a small business. One of the many wonderful things about the stuff that Ron explained to you is not only that it's really important to managing your business, but also it's something that you can do incrementally. He talked about a lot of things, and some of it was pretty sophisticated, but you can grow your way into it. And in fact, it will be a better process, and you'll probably get more out of it, and you're more likely to stick with it if you do it in some of the stages that he explained. So what we're going to talk about now is how to take all that work that you're going to have learned to do, thanks to Ron's great presentation, and become a little more proactive with it, and then start to use it as really a tool, not just to manage your cash flow, but to manage your business and grow your business. Once you're understanding your cash, you can smooth it out. And then once you kind of can predict it, you can start to think about how you can use it to grow your business, whether you use your own cash or use that as a basis for finding investment or funding from outside. And we'll talk a little bit about all those things. So as Ron explained, there are a lot of options when you have a cash crunch, a little bit of a shortfall. You can manage working capital. We just had a long discussion of working capital. You can cut some of your expenses. You can delay spending. And all of these work perfectly well. What happens though is, first of all, it takes you time. You need to not only identify the issue, which you should be doing anyhow, but then you have to come up with one of these strategies and make a plan to delay your spending or potentially negotiate with suppliers or with customers to cover that shortfall. That not only takes your time, it can have potentially have some effect on your relationship with vendors or customers, on your brand. Let's say you decide you need to do a fire sale, not a fire sale, but a kind of an emergency sale to generate a little extra cash. Maybe that wasn't really what you would have done for your brand otherwise. All of these things have some implications. So wherever you can, if you can go to a process where you're eliminating some of these bottlenecks ahead of time, it will not only reduce any potential impact it might have on your business partners, it will also give you some time back because you don't have to be managing these crises on an ongoing basis. And that also will give you a real basis for growth. There are a lot of ways to make your cash flow more consistent. One of the easiest ways is to make your inflows more regular. We're going to talk in a little bit more detail about this in a little while. This has to be right for your business. If you are a Christmas tree, if you sell Christmas trees, it's very hard to ask your customers to pay you monthly. They only need Christmas trees at Christmas time. But if you can think of a way to either split up the business so that you get your cash in more regularly and less in lump, or to encourage people to repeat, whether it's by a subscription program or a membership program, anything time you can encourage repeat customers, that will really help make your business steadier and more reliable. On the cost side, there are a lot of things that you can also do potentially to reduce spiky costs. You can smooth out payments potentially to like some of your professional fees. Maybe you're a lawyer. Instead of paying your lawyer a larger fee when you need specific advice, you may want to have the lawyer on retainer. You may want to have a more regular payment to your vendors instead of having to come up with large amounts of money just when the vendor payment is due. Remember that they also there's a value to them in having these payments be smoother, and so you should get something in return. Ron mentioned getting a discount. We would recommend that you offer your regular customers some kind of a discount. So if you're going to one of your vendors, it should be because you're saving money overall by doing this. The other thing is, this is not something for a new business to do. You want to have a little track record. For example, when you start your business, you're going to have a lot of exceptional legal fees that you're probably not going to have in the regular course of business. So you don't want to base that regular payment to your lawyer based on how much you spent year one when you had a lot of startup costs. So managing your cost is something that's really a little bit better when you have a little more track record and you really understand what you're going to be spending. And with that, this may seem unrelated, but one of the best ways I think to manage your cash is by using your bank account. So we're going to take a quick poll. Oh, okay.
Go ahead and give it a little
Sorry,
bit.
I was waiting for you, Kendra.
No problem.
So just here we have the poll. Just how many bank accounts does your company have? 1, 2, 3, or 4 or more? And there's no right answer. We're just interested to see how people manage their cash.
I'm going to give it just a few more seconds. Okay. And then I'm going to go ahead and I'm going to close out that poll and share the results.
Okay. So over half have just one bank account and the vast majority have 1 or 2. That is fine. And it's totally understandable. You're a small business and, why make things overly complex? Well, I actually really believe that in many cases, having multiple bank accounts will make your life easier. For example, I mentioned we ran I ran my own business. We had, in the end, I think 5 bank accounts, and we kept adding them because it made things easier. So we had one, this I recommend in almost every case. You have one account where the money comes into, but you don't spend money out of that. You have another account for paying bills, and you transfer money over as you need to cover your expenses. This will do a bunch of things. This will keep you from, I've seen many small businesses do this, you have an unexpected cash inflow and you say, oh my gosh, look how rich I am. Look I have more money than I expected, and you spend that money and you really didn't have it to spend. It was a timing issue. It also makes things cleaner. When you're doing the review that Ron recommended, having things split up will just make it so much easier to find things. And in fact, if you have a reasonable budget that you're comfortable with, you can have a regular transfer. Maybe you know that you have $1,500 of rent, utilities every single month, and you transfer that automatically. That way you'll know you'll have enough to cover your expenses. And if your amounts are off a little, if that operations account has more or less money than you expected, it will be an instant flag that either perhaps you didn't pay something or you had an unexpected expense. Beyond that, you may, the next account I would think about adding is a savings type account. You may just want to put your taxes, and I'm gonna go through a chart that explains this a little more. You may just want to take every month some of your profit, let's say about a third, depending on what your tax rate is, put it in that account. That way at the end, in next year in March, when you need to pay your taxes, all that money would be set aside. But similarly, either in that account or another one, you can also take a little bit of that extra money that you have and put it in this separate account. Out of sight, out of mind. That's how you build money to invest, whether it's in a project, in equipment, in a marketing campaign, in hiring new staff. You'll have that money to grow set aside already. Other things that you might want to add, in our business, we added 2 other accounts. One, we later, after we had started, we launched an e-commerce business, and that we had different vendors, we had different customers for that, and it was just easier to keep that in a separate account, so we could understand what was going on and it didn't get mixed up with our main business. Similarly, we later launched, we were very successful with our marketing business, and people wanted to just hire us as marketers. It was actually an e-publishing company. And so we set up an account just for the marketing business, and that was really helpful because we could see where every customer paid us, and then we could track the spending against that payment. And again, it wasn't clouded by everything else we were doing in our main business. Now, this is a little bit of a busy chart, I admit, but I'm trying to explain graphically how some of this might work. So on the top graph, we have a company, and the blue bars are our revenues, and the red bars are our expenses every month. And then this shaded area is an automatic transfer. I know in the beginning of the year, things are slower, so I'm transferring $11,000 every month over to the operating account. And you can see some months that's going to be a little too much, and some, I pay my taxes in April, that's going to be too little that month, but it kind of evens out. And I know that in the later months of the year, I'm going to need to step that up again. Again, it's a little higher or lower. Now, here's what happens in these bars down at the bottom. The blue bars are my revenue account. Every month, my revenue is coming in, and I'm transferring some out to operations, and I'm transferring a third or so, about a third out to a tax account. So it's segregated off in the side, and I know I have the money to pay my taxes. And then in this example, I took another, I think it was a half of all the rest of the money that was left after taxes, and I put it in a savings account. So look what happens over time. I actually build a little bit of working capital, to use Ron's term, in my revenue account, because I'm not transferring it all out. So if I have an unexpected expense, I've already got one cushion there. My operating account really doesn't change that much, and it shouldn't. As I said, we're using this as a reality check that I'm automatically transferring money in. I know what my expenses are. That account should more or less be a wash. And so if its balance grows or shrinks a lot, that's an instant flag to me to take a look at it. I'm building up the taxes, all the cash that I need to pay my taxes. And I know that that amount is set for taxes. So if I suddenly have an expense that faces me, I don't have to think, wow, have I saved enough to pay my taxes? And then I'm also building this nice little cushion off to the side that I can spend as I want to grow my business. I've covered a bunch of this already, but it also, as I said, it may sound more complicated, but having these segregated accounts will make them much easier to track. All the stuff that Ron's explained is really important things to do, but it's time consuming. And so if all I know, like income account, you can easily track. If your customer owes you money every month, it will be in that income account, and you won't have to sift through your phone bill and your rent check and whatever to find it. You can just quickly look and find if that customer paid you. Similarly, on your operating account, it's not all muddled up with other things. I want to see if I paid the cable bill, if I paid the Spectrum bill. It's right there. I can see it every month. And all of these things will help you keep the money that you, and then the savings and tax accounts will make sure that you have the money that you need or want, and you don't accidentally spend it for something else. While we're on the subject of cash, I want to talk a little bit about cash controls. This sounds kind of fancy, and it also, if you're familiar with the term cash controls, it may sound like something that only really big companies need, but every company needs some kind of cash controls. And in fact, even if you're a solopreneur, I would recommend this. I mean, as hard as you're working to make your money, as hard as you're working to manage your cash, it is really heartbreaking to lose any of it accidentally. And unfortunately, accidents do happen. And not everybody, sadly, is 100% honest. So there are simple things that you can do to protect your hard-earned cash. One of the easiest things is just to verify your payments at every step. Ron mentioned some of this. When you receive an invoice, make sure that it is correct, that it reflects. Your vendors make mistakes too. Make sure that the amount on it actually reflects the work that was done. If it's not a digital receipt and you need to input, make sure that it was input correctly. When you are, make sure that the amount you are paying matches the invoice. Go back to that invoice, have a system to record all your invoices. Another thing that sounds like an extra step, but that I really recommend, is to have kind of a weekly payables review. You're doing the weekly tracking that Ron recommended anyhow. Somewhere in the middle or the end of the week, list all the things that you need to pay next week. Get it out of your system. Pull the numbers out of your system. Check that they are correct, and that will also enable you to double check that you have the money you need to pay them. And then you also want to do a bank reconciliation to make sure that what you thought you paid was what actually got paid, that the check cleared as expected. Access controls means basically who has access, particularly to your bank accounts, but also if you, let's say, have a bookkeeper who you allow to pay bills on your behalf. That may work fine for you. You can't do everything. You're going to need to have people doing some things for you. But let's say, and again, this is another reason to have your accounts segregated, that bookkeeper, you only want to have access certainly to pets for actually writing checks to that one operations account. If you have a marketing manager, they may only need to see the marketing account. Right? They don't necessarily need to know every other amount of cash that comes into and out of your business. So that's another really important way to protect your cash. What we call segregation of duties, which just means don't have the fox guarding the hen house, right? Again, if you do say to your bookkeeper that they can pay some bills on your behalf, there better be then somebody else. Do not also have your bookkeeper inputting the invoices and doing the bank reconciliation, because there's no way to check if that person made a mistake, whether intentionally or accidentally. You may want to have people in your staff inputting the amounts, and then only allow the bookkeeper to pay the amounts that came off of your listed invoices. But you want to have whenever money's going out of the door, you want to have a checks and balances. And particularly for large or unusual account transactions, over a certain dollar amount. Wire transfers are sadly an area where there's been a lot of small business fraud lately. If there is a wire transfer request, maybe you need 2 people to authorize it. For a lot of these things, controls on larger amounts, on wire transfers, most banks will actually let you set this up automatically, and it will notify you if a transaction was requested that was over the limit. The banks don't want to pay fraudulent or mistaken amounts either. So they're on your side here. As I said, most of this you may be able to do yourself just online on your bank account, but if not, talk to your banker. All of these things will take a few minutes, really, really worth it. Okay, so now we've gotten the cash controls out of the way. Let's talk about growing. That's even more fun. We talked a little bit about ways to stabilize your cash, and we're gonna dig in a little more deeply now. Because these are also, many of these things that will stabilize your cash inflows will also help you grow. And so any kind of a membership or loyalty program, this can do many things. It can help bring in customers. I mean, if you see, most coffee shops or, even spas or hair salons or things like that will have some kind of a discount or some kind of an incentive to have you come back more regularly. They want to make it worth your while, but as we've seen, having that regular inflow is worth your while as well. So it's worth giving up a little bit of a discount to have people return more frequently. You also can use that sometimes as, some membership programs are effectively pre-sales, like a lot of gyms or let's say a yoga studio will sell you class packages or a monthly pass or something like that. That again, now I know I have this regular amount that's coming in. I'm not worried about the actual week by week or day by day class schedule. Referral fees, that's not necessarily a pricing, but giving a discount for somebody who refers a customer to you is good business. Getting customers is really expensive. The timing is uncertain. Ron talked a lot about, I'm going to talk a lot about, timing is really an expense. And so anything that you can do that will get you new customers or repeat customers more easily, more quickly, means actual dollars to you. And so you can afford to give a reasonable discount to make that happen. Subscription programs, or what we call razor and blade, where you sell one thing and then add on a service or additional products going forward, is another good way to regularize your cash flows. And then things like packages or tiered pricing will incentivize the people who are already working with you to buy more. Or if they're on the fence, to perhaps buy a greater quantity than they originally would have. This will help bring in more revenues, will help smooth out your cash flow. As a little bit of a plug, Tim mentioned that we're having another webinar on the 28th of June. We're going to talk a lot about pricing and specifically how you can use pricing to incentivize your customers to do things that are profitable for you. So I'm a huge believer in this. I'm only going to cover it pretty briefly right now, but there's more to come. So once you've done that and you're starting to bring in these steady cash flows, you've actually created a great platform to start to grow your business. And importantly, by doing some of these things, implementing some of these programs, you may start to get an inkling of what will really work to help grow your business. And so at that point, what you really want to do is have a clear, simple plan. This is not SCORE teaches wonderful webinars on building a big, complicated business plan. This is not, this is the opposite of that. This is, I want to add 10% more customers, and here's what I need to do it. Or I would like to open a second location, and here's what I need to do it. It's a very clear goal with specific deliverables and specific requirements and a cost. How much do you need? When will you need to spend it? When will it start to show returns? And how are you going to measure? That's all you need to do. And with that, we are going to take another quick poll to look at whether people are planning to grow their business. And if so, if you're looking at outside funding to help you do that. And again, you don't need to have a specific plan, but if you're even thinking, in the next year, what are the possibilities of how you might, draw on credit cards or lines of credit or take out a loan or find an investor to help your business grow? And choose all that work for you.
Yes, select all that apply, and we'll go ahead and give it a little bit because I know there's a lot of options and you need to make your selections. We'll give it just a little bit longer, so go ahead and make your selections. We've got a lot of them coming in, so I'm going to give it just a little bit longer because there are so many options. Okay, I'm going to go ahead and close out that poll and share the results. Just so people know, we had, I believe it was 79 people. This is out of 79 people who responded.
Okay, great. Well, look at this. I mean, so there's a lot of people who have some kind of growth plans and are looking for funding. About 20% of you don't think you'll need it. That's also excellent. This is really good to know. What we're going to talk about now is how to grow, perhaps without some of that outside funding, and in a way that will definitely make you stronger should you need to look for outside funding.
Can I sneak in a couple quick questions?
Sure.
About the content that you just covered. Do you recommend having all separate accounts with one financial institution or several institutions, thus building your banking relationships for when it's needed in critical times?
It's a good question. I think it's really up to you. Most banks like you to have, first of all, the first thing is fees. Like if it's going to cost you a lot in fees to have multiple banks, don't do it. It's certainly simpler to manage if they're all at one bank. But as we saw in COVID, different banks had very, very different track records in kind of standing up for their customers. So in this day and age, I'm all for having a couple different accounts. I know I didn't answer the question. It comes back to what's right for you.
Thanks. Hold on to the other questions for when we do a bigger pause for Q&A.
Okay, thanks so much. Now, as I said, part of having a plan is having a really specific plan. So, everybody's plan would be, I would like to sell more and make more money. But that really is a pretty hard one to execute. If just saying it made it so, everybody would grow and make more money. So, there are a lot of different directions you can grow. You can just do volume growth, is just doing more of what you're already doing. You can expand into what we call an adjacency, which is you can open a new store in another neighborhood. You can serve another type of customer who might want the products you're already selling. Channel expansion means you can sell in more ways. You have a store and you'd like to go online. Or you're selling a product in your store and you might open some wholesale accounts and allow others to sell your product. You can add to your product mix. And you can also expand through partnerships in ways that kind of combine many of these strategies to help you grow. It's important to think about how you want to grow, not just that you want to grow. The other thing is that as a business owner, most business owners are visionaries. They have an idea of how big and exciting their business could get. But as you already know, if you've launched your business, you need to do it in stages. And so when you're thinking about this very specific plan that you want to fund, one thing that's really important is to think about what are you going to do in what order. It's not going to be possible to do everything at once, and it's actually going to be harmful probably to your product. As much as you think that you need a salesperson and a new store and additional equipment and 7 new products to really get you what you want, where you want to go, trying to do all of those things simultaneously is probably going to be much harder than you expect and lead to more problems than it needs to. So sequencing is really key. So with that in mind, once you've thought about what specifically you want to do, how you want to grow, and what your priorities are, you can start to think of ways to apply what we call creative funding, which is how do you keep from borrowing or raising external money? How can you either use the money that you have or basically spend less money? And it comes down to not just spending less money, but something that Ron really emphasized, and it's really important, it's timing. If you need to spend money, can you get the cash in before you need to spend it? Then you don't need to raise money externally. So the first of these is find funds in your business. That we've already talked about. Ron talked about how to monitor that. We've talked about how to potentially, certainly track it and potentially use bank accounts to put some cash aside that you can use then to fund whatever your business initiative. That's definitely something everybody should be doing. That's part of normal planning and budgeting. Each of these others we're going to go through in a little more detail, but the next 4 really come down to managing that timing of when you spend cash. So you may ultimately spend it, but if you can get the cash in before you spend it, you won't need to look outside. And then the last is look outside less. And we'll talk a little bit about that. So cash first, pay later just means, what it says, get the cash in before you need to spend it. As I mentioned before, in our business, we launched a e-publishing business, and then we later started an e-commerce site of our own. We funded at least part of that. We had some money that we had saved internally, and we funded the rest with gift cards. That allowed us to market that we were out there, that got us some cash. It got us some, kind of really invested customers who were eager to start buying and tell their friends, once we were up and running. That worked for us. For people, I've worked with people who are launching, say, a software product. I'm a huge believer in getting the customer to say, let's say you want it ultimately to be a monthly product, get the customer to pay a lump sum up front, or get the customer, tell them there's a customization fee or a training fee, or call it what you will, but get some of that cash up front, especially if you're going to need to pay a programmer or you're going to need to pay somebody to support that account. On the other side, you can delay paying for things. If you know that money is coming in, perhaps your vendor will accept a later payment. You may need to pay, again, all of these things, the vendor's another small business person like yourself, right? So all of these things come with costs and balances, but if you pay your vendor a little bit more to accept payment after you've already been paid, that's effectively cheap funding for you. And now, again, you don't need this working capital loan or to take out a credit card debt to fund that, the inventory purchase until payment. And you don't have to do any of these things entirely. If you can get the vendor to take half of the money later, that's a benefit to you. So start where you can and get to where you can. Anything that helps address the funding mismatch of having to spend money before it comes in is beneficial to you, even if it's for only part of the payment. Another one that people really overlook is what I call borrow, don't buy. And you would be surprised what you can borrow. And by this, I mean, there are a lot of things that you think you need to expand your business that you may ultimately need, but you don't necessarily need right now, or somebody else may have. So for example, I mean, real estate is one of the most expensive pieces of any small business. So if you, let's say you want to go open a store in a new neighborhood, instead of going out on spec and finding a location and paying a deposit and building it out, perhaps you can launch, let's say if you have a retail boutique, maybe you can launch a kiosk inside of an existing store, or you can partner with a salon or with a spa to advertise your product there and build that clientele. And when you know it's going to be a go for you, then you can open the store. If you need expensive equipment, maybe there's somebody else who has that equipment that you can pay per use. Again, it may be more expensive than having that equipment, but you don't have that upfront outlay, and you'll spend the money only when you know that you really need the equipment. You can even borrow a sales force by subcontracting or by paying a finder's fee or a commission to somebody else's salespeople. Rather than hiring and training your own before that you know that you're going to have a need for it. So all of these things will help you understand. And then if you do need to spend the money, you'll know it's worth it. And if you do need to borrow the money in order to purchase these things, you'll have a really great case to make to the lender for why it makes sense for your business. One of my favorites is spend from receipts. And that means basically wait until you have the transaction to pay, even if you pay more. So for example, instead of going out and doing a big marketing campaign, which if you run right, you may have a very low customer acquisition cost. When you're testing out something new and you don't have money to spare, spend actually perhaps even a little bit more per customer for the customers that actually come in. A referral fee, bring a friend, any of those things. A discount on next purchase is a way to get somebody to come back who's already been here once. All of those things, those are times you are giving money out of actual cash that you are receiving. Finder's fees or any kind of a commission, again, is sometimes where you only pay money for a transaction that's actually occurring. And this is all, when you're getting started, this is really, really valuable. Again, down the road, when this stuff is all running like clockwork, you can go to a different approach that may enable you to save money, but this is saving you cash up front, and that's really important. In all of these things, whether it is, finding equipment or a location that you can borrow, finding a sales force that you might be able to pay on commission to help you grow, it's really important to think about whose interests align with yours. Now, often your vendor's interests align with yours. So negotiating with your vendor is one clear way to go with all of this. But, for example, when I had the example about expanding my store into a new neighborhood, that spa that I partner with to save having to rent my own location, now they have something new. If we have a similar clientele, they have something new to promote to their client base. It's beneficial to them. Many more businesses than you think are actually your potential allies. We tend to think of all other businesses as competitors, but you have a lot of allies out there. And so what you may be able to find what you want, what saves you money in a way that actually helps your counterparty as well. And then I've written here at the bottom, as a bonus, if you do go out and look for investors, many of these same overlapping interests are your most likely investors. So basically, this is a little bit of a lot going on, but as you think about, you've now honed it down to what do I really want to do, and what are the 1 or 2 things that I absolutely need to make that happen, start to think about how you can reduce that, how you can get some funds in ahead of time to pay for that spending, who may have it or who may benefit from you being successful in this. And again, it's all about priorities. Is this really the thing that you need to be doing right now? All of this will help you come up with a strategy that will not only save you money, but really in almost all cases will strengthen your business. Because look, now you have a built-in partner. You have, if you're using the pop-up, you have built-in customer flow that you didn't necessarily have if you started cold. A lot of these things have business benefits as well. But whatever it comes down to is you have to ask. People who are so bold about starting their business are sometimes very nervous about asking for things. But the key is, as we've given in all of these examples, to know what's in it for the other person. If you go to somebody and say, hey, can I use your fancy printer once a week? They might say, they may very well say yes. But if you say, listen, by allowing me to use your printer, I am going to, do X, Y, or Z for you. I'm going to expose you to new customers. I'm going to allow you to prove out your capabilities in some new area. Maybe I have a clientele that you don't have, and you'll be able to prove to artists or to designers that you have a capability you didn't think you had before. Know what's in it for the other side before you ask. And again, once you're thinking about what you want to do, there are many paths forward. So it comes down to what works for you, and who do you know, and who has overlapping interests, and who can you ask. So let's say, for example, I am a photographer and I want to get into social media marketing. There are a bunch of things that I'm going to need. I may need new staff. I may need additional marketing to prove that I have these new capabilities. I may need additional equipment. I may need to expand geographically. I don't know. There's no one right way to do this. Over with the arrows on the right, I could expand via partnership. Instead of worrying about saying, hey, Carolyn's photography is now in the social media business, I can go to people who I'm already perhaps doing marketing, doing photography work for, and say, listen, I'll manage the Instagram accounts for your clientele. I'm already, I'm very familiar with images. I know how to work these. I can start doing that and getting paid for that business without having to build up my own clientele. And then as I need to, I now have case studies that I can market. I can start building up my marketing. I can see what staff I need and hire them. I may want to do it myself, but I wouldn't necessarily want to hire in the bottom arrows. I wouldn't necessarily want to go out and hire people on salary to help me. I start with contractors. They may be more expensive on a per hour basis, but again, pay from receipts. I'm only paying them when I have a project and I have some revenues coming in. And then over time, that allows me to broaden my base. So there's no right or wrong sequencing. Do what works for you. Another thing is that once you've prioritized and decided what you're doing, you can combine various strategies. So let's say I want to grow my business by launching a new product. Well, traditionally, I would go out, I would spec out that product, I would pay a producer, I would pay for the inventory, and then I would sell. That has a lot of upfront expense. It has a lot of uncertainty. One way I can reduce that is by negotiating with my vendor. If I already do a lot of business with that vendor, it's in their best, again, it's in their best interest if I have more products, right? If I'm ordering more from them. So I may be able to work with them. I may be able to do some kind of a pre-sale. You loved our shampoo. We are going to be launching wonderful conditioner in the next month. If you purchase it now, you'll get a discount, or we'll give you your third bottle free, something like that. I can work through channel partners or others to help me get my new product out. So you can combine a lot of strategies, even when you have a very specific goal. So the goal here is really figure out what you absolutely need, know where you're headed, have that goal in mind, and then be super pragmatic. There's no right or wrong answer. There's what's right for you based on your product, your service, your business, and who you know and who you can find to work with. And as I said, there are many benefits to self-funding. And it goes way beyond not having the time, avoiding the time and expense of going to a lender and trying to borrow money. You as a manager, you already have your business to run. You can focus on doing just that one thing. If I expand via pop-up, I don't have to worry about outfitting that whole new location. I can just worry about finding the customers over there, and then grow into managing my location over time. I'm funding myself in a way that helps my business grow. It's not sort of an extraneous thing I'm bringing to the table. And I say as having worked as a lender for many years, the difference between saying, I'd really like to open a new store in the next town over, and I'm really pretty comfortable it will work, and being able to say, I have a really solid store in my town. I have a restaurant in my town. Once a week, I've been running a kind of a pop-up restaurant in the next town over, and it's been super successful. And I've built up a client list over there, and I kind of know I've tested out what the differences in taste are, and I've actually been able to attract maybe some staff. And now I have all the pieces in place. I want a loan so that I can open a restaurant in that next town. It's just a much stronger loan application. And you know that it's worthwhile before you go out and spend all that money. So it's a win-win for sure. If you still need outside funds, you've gone through all of this and either you just can't fund it on your own, or you've been funding it on your own for a while, and now you see that there really is this opportunity to purchase that equipment or to pay for additional staff or whatever it is that you need money for, the same thing applies. You want to have a very specific, very clear plan. What are you funding? Where will it get you? What's the right funding source for you? Now, I've run entire webinars just on this question, so we're not going to go into this here, but just because the store next to you or your friend who runs a similar business found an investor or got a loan, that may or may not be right for you. Again, it's very specific to you, what you want to do, what you're funding, your background. There are a lot of different questions involved, but work with somebody to help you understand what the right options are for you and know how that will benefit your business. If you are looking for investors, despite all of that, again, this is another long topic that I won't go into too much detail here, but you probably know your best investors. That doesn't mean it's your Aunt Sally. It may be somebody strategic or somebody who understands your business, who really likes what you're doing, who's going to back you. So broadly speaking, there are many different funding sources, but they come into part of it is timing. So if you have a short-term funding gap, which is usually you are purchasing inventory and you're not going to be able to sell it for a little time, or you need to develop a service and you're very sure that you have a customer for it, but you need to hire some contractors or you need to hire some staff to get yourself up to speed. That's a short-term funding gap. Typically, those can be funded with things like credit cards, factoring, loans from vendors or contractors, or implicit loans, even if you pay your vendor more to basically take the float for you. Those will often be quite expensive on a percentage basis, but they're fast. You can, a credit card, if you have the capacity, you can be up and borrowing on that credit card, in a couple of days, whereas a bank loan will take much longer. And it's expensive per month, but if you know that you only need it for 4 months, you pay it off and you're done. So if it's a short-term gap, look for short-term funding. If it's something a little longer, and particularly if you're purchasing what we call hard assets, you're opening a store, you're buying equipment, you're doing something where you're actually, going out and purchasing something, that's what banks tend to like. Then you can get a loan. You may be able to get a mortgage. There are many types of loans. You should do all sorts of research on that. But what's going to be important is that you're spending it on something specific, and then within a foreseeable amount of time, it will generate enough cash flow to pay for itself. So that's a loan. If that is not the case, if you are developing a brand new service, if you are a programmer, if you want to do more marketing is a soft cost, and you have, particularly if you don't have a lot of track record. If you have been marketing on Facebook and you can show with precision that you get each customer for $3 and you make a $20 profit on that customer, so that's a very good cost of acquisition, you may be able to borrow for that. But typically, these softer costs are going to be something that you need investment for. Now, investors are hard. This might be a case where you want to focus on getting a loan for the hard costs and do some of the strategies that we've talked about to support some of the soft costs. Another thing when it does come to investors, though, is not every investor is like Shark Tank. It does not automatically mean that you need to go out and sell 20% of the company. In fact, in many cases, there may be a structure that works better for you and your investor. If you are opening a store, for example, having equity in your store is honestly not all that valuable to an investor. But if you tell them that once I am profitable, my cash flow is positive, I am going to pay you X% of my cash flow until you have earned 150% of your investment. Now that's a nice strategy that works for everybody. You're only paying money you have, and they are getting a cash return that's preferable to almost anything they can get out there. So there's a lot of ways to structure an investment that's good for everybody. And I mentioned this before, if you do need an investor, also really, in most cases, for most small businesses, certainly your initial investor is not going to be a VC. It's rarely going to be even sort of a, kind of fancy professional angel group. It's very often going to be somebody somebody who understands the business, maybe somebody you don't necessarily know, but has been in the business, appreciates what you're trying to do, somebody with a complementary product or service, who will benefit as you grow. Understand what's in it for them. They also may not want equity at all. They're just being able to access your product at a preferential price for as long as you're, making that product may be valuable to them, being bundled in with you, being co-branded with you, selling through your sales force or vice versa. All of these things may have made much more value to a strategic partner than equity does. So, again, it's always about thinking what's in it for them. And at the end of the day, I think what both Ron and I have said is the bottom line is cash is king. Understand your cash flows, do what you can to manage and smooth your growth, and then use it to grow your business. Remember that time is an expense. So doing whatever you can to make things happen a little faster without that time delay of either getting a loan or building your own capabilities really, really, really has value to you. And done right, your funding strategy will not only help your growth, it will be part of your growth, and it will make your whole company stronger and better. And with that, we'll take some questions.
Thanks, Carolyn. So our first question is, next slide, please.
Oh.
Thank you. What do you think about using a program like Patreon that has tiered pricing, subscription, membership, and packages?
Patreon, it's not knowing your business, it's hard to answer. Again, all of these funding sources are great in certain cases. Patreon, in my experience, is really good if you have an ongoing service or product It tends to be focused on sort of artistic projects, but it can be other things as well that people want to participate in. There are a lot of podcasts now that are funding on Patreon. I worked with somebody who had an undersea sculpture. It was really cool. And it needed a lot of upkeep, and people really in the locality really loved this sculpture, and they participated via Patreon to pay for the upkeep of the sculpture. So again, it's with funding, whether it's a funding specific source like Patreon or whether it's a partner, it's really, does it make sense for the people who are going to give you the money?
Thanks. If you have bottles or jars that you haven't used or filled with product, what category would it fall under? Assets, inventory?
Ron can take that. It's basically inventory. And so if you're not using it, you can find somebody else who wants it and sell it to them.
Great. The question, what is the name Patreon? You can Google that. It's a, Carolyn, can you say a few words about
Yeah,
Patreon?
sure. Patreon, I think of it as, it's not exactly a crowdfunding source. It's really a way, it started as a way for artists to get paid for their work. And there are a lot of, there are songwriters who are on Patreon, and people pay them a monthly stipend. And yeah, I think the questioner asked, there were tiers to it. So you could say, okay, if you pay me $5 a month, you will be one of the first to receive my new songs whenever they come out. If you pay me $25 a month, I will actually once a month, I'm going to have a private concert for all of my Patreon subscribers, and you can see what I'm working on. And you can, if it's $50 a month, you can, request that I play a particular song in those concerts or something like that. You can come up with tiers of service for people.
Thanks. This is a detailed question. So would seeking new opportunities be considered growth potential for a small business, such as looking for other business sectors that a small business can provide value in? For example, a data management or data processing company that primarily does research-related topics could go into sports gaming or betting.
Yeah, absolutely. Any of those are, back to my chart, new products or adjacencies or new customer types, depending on, the exact nature of the growth. And those are all very valid ways to grow. Understand that the larger the leap from where you are to where you're going, the more risk. And probably the more new capabilities you're going to have to develop, the new things you're going to have to invest in, the longer time it will take. Maybe there's a way in that example to go from the data management that you're doing to doing a kind of data management that will enable you to build up expertise in gaming, and then use that as a launching pad to do the gaming business. Oftentimes you can get there faster by taking an interim step, which helps you get, I call it paid R&D. That basically, if you can find somebody who will pay you to learn what you want to learn, that's getting you in that direction you want to go, it may be worth taking a little interim step to get there. But sure, you can grow in any way.
Thanks. I'll just remind everyone, this is our final Q&A. So if you have any questions, now's the time to submit them. Your question to the previous question was yes. Do you have any examples of avenues of small businesses can utilize to understand their value and how they can leverage that value to other business sectors as applicable?
Well, if you're in the data services business, I think it's often a case of stepping back a bit and looking at how people are using your data. So let's say that they are using your data for to plan their supply chain, right? By understanding their customer flows or whatever kind of data you're managing for them, they can actually smooth out their operations, and that has value to them. There's almost certainly other businesses that need that skill set too. It's really, I would start by figuring out what customers are really using this for, not who your customers are. My customers are architecture studios. Well, that's good. What are they doing? and what other businesses need to be able to do that same thing. There's almost always another business that has those same needs. You may need to repackage it a little bit. You may need to find a partner who can help you get to those other customers because you don't know them. Another trick that I've used with people who wanted to grow is to, if you have customer reviews on any format, Yelp, or testimonials that customers have sent you, or even just emails that customers have sent you telling you what they appreciate about you, read that. Because you have an idea of how the customer is using your product or service, but they're telling you what they're doing with it. So oftentimes you can get some really good clues from reading what customers say. Thank you. Using your data service really helped me do A, B, and C. And then you can think about who else needs to do A, B, and C in a slightly different form.
Thanks. What percentage do the average VC expect as their equity share?
It really depends on many things. Basically, everybody's heard the term risk reward. So the higher the perceived risk, the greater the reward that the VC will require. And the only way to get more value as a VC is to take a higher share. So risk comes in being earlier stage. It comes in asking for more money. So if you ask for $1 million, let's say the VC would take 10%. If you ask for $2 million, they would probably take 25. It doesn't go up proportionately because investing $2 million is much riskier than investing $1. The rule of thumb is that an angel investor or a seed investor is often going to be looking for 10-ish%. And then that your first real VC round is going to be 20-ish%. But all of these numbers change wildly depending on the circumstances.
Thank you. What percentage of revenue would you recommend to allocate for automatic savings transfer monthly?
It's really a percent. It should be a percentage of profits, not of revenue. But again, if you know in general that you have, let's say, a 30% profit margin, and so that means your 30% of your revenues are profits, and then a third of your profits you need in taxes, so that's another 10%. Then you have 20% of your revenues that you can potentially save, and it's up to you. I would never put 100% of it in savings because you're going to need some. There's always going to be unexpected expenses. Your pipes are going to break, or your computer's going to break down, or whatever. So you want to have a little cushion. But in that example, if you had a 30% margin, you were putting 10% of it into savings. You had 10 or 15. So between half and a third of your profits into savings. And it's up to you too. You can see how it works and change the percentage as you get more comfortable.
Thanks. In seeking funds, you have to be very optimistic in order to get it, maybe too optimistic. And if you're too realistic, it could mean probably no funding. How do you solve that dilemma?
It's a good question. I would take a little issue with it, and it also depends what kind of funding you're seeking. If you're seeking a loan, you want to be really realistic, okay? Lenders are in the business, lenders would love your business to grow, but all they really want is to get paid back. So if you're too optimistic and you're painting this, pie in the sky scenario that they can't believe, you're not getting the loan. Whereas if you actually are, I always tell people who are looking for loans to be very conservative. As long as you show that very conservative, very doable assumptions will pay back that loan, that is way, way better. If you're talking to investors, you do need to be optimistic. Again, this is a subject for a whole other webinar, but about how to deal with investors. But if you're looking for an investor, the key there is usually that this amount of money that they're investing will do something very specific that moves the business forward. Instead of saying, with this $1 million investment, I'll launch 5 new products and open a business in Canada and, be selling through 2 additional channels. say, this $1 million will help us launch 2 additional products that we already have in the works that could double or triple our sales, and that will enable us to attract a channel partner that can help us grow. Like be realistically optimistic, I guess is the way I put it.
Yeah, this is Carolyn, if I can add to this, because this is a good one. I've seen it a lot. You really want to be very careful. Your enthusiasm and optimism can be in your commitment to the business and belief in the future of it, but you want to be able to underpromise and over-deliver. Because what happens is if you're overly optimistic at the outset and you don't meet those forecasts or that level of optimism, you've set the stage for disappointment with your investors, and it becomes an issue with trust in the future. They want to know that when you make a statement that they can really believe it.
Thanks so much. With that, those are all the questions that we have. So thank you so much, Ron. Thank you so much, Carolyn. If you have questions, a great resource is going to be a SCORE mentor. And we put in chat where you can find that, but it's that score.org. Just takes a few minutes to find a mentor. Again, our services are 100% free. So you really, if you have not tried us out, please try us out because, as I said, we're a great resource. This is the score.org page. You just click on that find a mentor option up there. Just takes a few minutes to fill out the form. We are going to send you the slides as well as the webinar recording that will go out tomorrow. So keep an eye out in your email box for that. We would ask that you fill out an evaluation survey to let us know how today's webinar was. What was great about it? What could we do to improve it? So keep Zoom open after I close out the meeting. Keep that Zoom open. You're going to see that evaluation survey. Please just take a moment to fill it out. It gives us very valuable input. With that, again, thanks, Carolyn and Ron. Thanks, Jim, for being on the back end and answering questions. And thanks to Jennifer and to Tim for our intro. So with that, thanks, everyone, and enjoy the rest of your day.
Thank
Bye.
you so much. Bye-bye.